Hi, I'm McEachran. Welcome to Money Matters. Today we're going to talk about a few things. Kind of rehash what we've done with your portfolios in April. Quickly, as you went to your mailbox, you probably noticed a lot of envelopes, and those envelopes really what you would have noticed, your defensive positions in your portfolio were changing over quickly. What the changeovers were is your interest sensitive defensive positions were becoming credit sensitive, and without going into great detail of what that means, is that basically you're trying to get your portfolio more ready for interest rates increasing whenever that does occur. I think the Fed has sort of indicated it could occur as early as next year, and when inflation does occur. So when interest rates do start to go up, I think we'll probably see inflation, real inflation, begin to occur then also. So we're preparing your portfolios for that. So that was the gist of what we did in your portfolios on the defensive side. As we moving into the second quarter, where the S&P is reporting, and we're glad to say there's some good news and there's some bad news. Good news is over half the companies have reported, John, and of those companies, earnings are up.
Earnings are up. We do anticipate, like most summers in the times past, that probably the second quarter is going to be a little bit flat. We think the trajectory of where the market is going by the end of the year is still in an upward moment, but we wouldn't be surprised if we're flat and maybe a little bit down during the second quarter. We are concerned about that. We look forward to the end of the year and the right trajectory that we think the market is on.
The earnings, as I said, have been up. The bad news is that revenues are down, and companies really are making money by cutting and not hiring, and the environment for hiring is still not very good. Companies, for the most part, are still in a wait-and-see mode. Healthcare costs are an indicator that they're not sure what those costs are going to be. They're not quite sure what the taxation is going to be. So big companies and medium-sized companies are kind of just standing put and not hiring. So the second quarter could be a tad bit rocky. We do have some buffers, though, that we didn't have in the second quarters of the last 4 years, where we've had this sort of cycle that we've seen: a good first quarter, bad second quarter, neutral third quarter, and a good fourth quarter. Those buffers are that we're seeing an influx of money from other countries because, as we jokingly say, we're kind of the best house in the ghetto of the world. Our markets are a little bit more solid. We're seeing monies come into both types of markets, whether it's the bond markets or the stock markets, and both are benefiting from that. We're also seeing a resurgence in the housing market finally after a 5 years of doldrums. So we're seeing that occur, and that's helping give a little bit more stability to this second quarter. And as we move through the year, I think we'll see those trends of a kind of a neutral third quarter and hopefully a good fourth quarter, but it's still too early to tell.
We'll continue to monitor the accounts as we do, look at the underlying holdings of it, and as the summer goes along, we'll be back in touch with you and let you know if there's any changes we are making and let you know what we're thinking about. Have a great summer.
As always, it's your money.
And your money matters.